Hey, it's me here after the market close on it's Monday, March 10th, and the S&P was just about down about 2.7% today, and it's been a tough month. So I thought I'd give some perspective and predictions, I guess, if you want to call it. So let's run some disclaimers and I'll be right back. So after today, let me share my screen here. After today, the S&P ended at 56.14 today, so that's a change since the beginning of the year of 4.5%. Hold on, please. Oh, there we go. Meant to include February too. So a change for the month of negative 5.71, a change year to date down 4.54, a change since its all-time high, which was, or its all-time monthly closing high. It's not a daily high. It's monthly closing high in November of 6032. So it's down about 7% from its November closing. However, since the end of 2023, it's up 17%, and the end of 2022, it's up 46%. So still over 20% a year for 2 years, a little over 17% for a little over 1 year. So that's the perspective, that's the perspective of this. Absolutely not fun to watch right now on a daily basis, but we've yet to give back all of our substantial gains. But let's look at this another way too, please. So through the website Portfolio Visualizer, I know this has pretty good data on drawdowns. And so what I did is I set up a portfolio, let's call this U.S. stock market, right? This is so when we get down there, it's easier to see. U.S. large cap growth, and then global, but actually I'm going to do this, bonds. I meant to do bonds. I've been looking at a lot of things today. So total U.S. bond market. So maybe I should call that U.S. bonds. Okay. So I have 3 asset classes in here. U.S. stock market, the total U.S. stock market. I put in U.S. large cap growth for lack of better selections here. I don't think there's anything that is technology focused. So U.S. large cap growth has, of all these asset classes, probably the most in technology, which has been hit the hardest. And then we have bonds in here. Let's see what bonds have been doing. Let's see what bonds have been doing over the period I want to show. And we have settings here of the longest running data this system has. I put in 1972, but I think the bond data is going to cut that short. And the end year is 2025. So I'm not really quite sure what the year to date, how far into 2025 that goes. Let's just do 2024, because the point I'd like to make is, if you ask, well, how bad can this get? It's tough to say. We haven't had such tariff testing in recent memory. We have testing of tariffs slowing down growth, interest rates which are moderate. They're not high, certainly by historical standards, but not as low as they have been. So again, we're in one of these positions of we've never been here before, and so how is this going to go? And every market pullback is the same, and it's that something happens that's never happened before that sets us off track. And for how long will it set us off track? So what I've done here, so we have a $1 million portfolio for a long period of time, as long as this data has, because of bonds, this will put the data back to 1987. So let's actually can I go back further? Let's get bonds out of there. Maybe I should take this a different approach. All right, so we have the U.S. stock market and U.S. large cap growth since January of 1972 through December of 2024. That's enough data to make the point I want to make. And the point isn't how well the markets have performed over that amount of time. It's how well they've performed intra-period when the going gets tough. And so what I'd like to do here is go down to this, the drawdown section of this website. And you can see that we have large cap growth is green and the U.S. stock market is blue. And you can see when we've had tough times, large cap growth has been more affected. I kind of can't get that darn box away, but every time we go down, large cap growth seems to go down more than the overall market. And what this does is it shows us kind of the worst periods, the 10 worst periods, and this will be for the total U.S. stock market. The worst drawdown we had was 50.89, and then we had a 45, a 44, and a 29. Let's see how that compares to, and then here I'm on the screen. Where can I, not really sure where I can hide me. Maybe I'm better over here for just a little bit. No, let me just keep myself, sorry guys, keep myself down here. So the worst periods for the U.S. stock market, let's call it 50, 45, 40, and here's 53, 53, 33. So the first two periods are worse, the third period's not as bad. But let's get the picture here. So large cap is here, large cap growth is on the screen yet. So large cap in the insert, in the inlay, whatever we want to call this, the pop-up, we had an underwater period of, we had a period where from during the trial, we were underwater. It took you 4 years and 5 months from a 50% drawdown to get back to even. Here's a period where it took us 4 years from a 45% pullback to get back to even, and a 5-year, 8-month period on this 44 to get back to even. And that compares to large cap growth, which had a 53% drawdown and took 7 years, 7 months, underwater period. That means from the time you started losing money to back to even. 7 years, 7 months, 12 years, 5 months, and 2 years, 1 month. Well, out of all of these periods, the longest amount of time for these large cap growth funds was a 12-year, 5-month underwater period. April 2000 to September of 2000 is when the pullback occurred. And then it took until August of 2012, so 9 years and 11 months to recover, but a total amount of time of 12 years from when a pull down occurred to back to break even. So that's with a high octane growth portfolio. And yeah, that was a lot of time. I mean, memories are short, right? I kind of remember going through that. So much more happened though. But that focuses on large cap growth, which is a lot of tech stocks. And that was from, April of 2000. So that's the March of 2000 was the bursting of the tech bubble. And so for a lot of technology related and growth stocks, it took, well, again, 12 years and 5 months to get back. The same period of time here, that was tech stocks. The S&P finally broke in September of 2000 and was more of a 6-year. It took half the time to get back. Now, I wonder if that's, well, let's just do this. Let's change this then to a time period of the year. Let's just go to the year 2000 for the sake of this, just as the starting point, because this will give us a good graphical representation. So green is large cap. Green is large cap growth starting with $1 million, and it doesn't get back here again. Look at that. March, April of 2012 is when the green line, can you see what's going on there? We started with $1 million here in the year 2000, and we didn't get back to, in large cap growth, the lower number, we didn't get back there till, well, that February of 2012, the thing said April at the bottom, but nonetheless, 12 years whereby the total U.S. stock market had recovered, right, by There's $1 million in the top number. By January 31st, 2006, drops again and then gets back to the $1 million by March of 2010. So some rocky roads. And then finally here, I mean, I think it's worth pointing out that with that approach, large cap growth kind of gets ahead and behind, and finally, right now, still ahead, but potentially dropping more quickly. So had you ridden through that, you'd be ahead with large cap growth. But if you were conservative or if you were pulling out money during this amount of time, large cap growth may have even run out of money. So the point, I'll check that in a moment now that I say it, but the point I want to make is just focused on the U.S. stock market. I mean, sometimes during pullbacks, albeit this pullback not as bad as this one, right? 44% is not as bad as 50. Just the period underwater, almost 5 years, 6 years underwater till we got back to where we were. January of 2020 to March of 2020. I mean, COVID, we pulled back 20%, and it took 7 months to recover. I mean, a quick shock. It was a 3-month drawdown, and then 7 months to recover. So that's pretty quick, relatively speaking. I mean, this drawdown, we drifted down. We drifted down for 2 years. And then it took 3 or 7 months to recover. So a total amount of time of 6 years. That was, that's a long, that just takes patience. That takes patience. It depends where you are in your life for how easy it is to tolerate that. Get a little bit over a year decline. How long is it going to take this tariff debacle to pan out? Well, I don't know. I don't know. I don't know. But I just want to kind of put into perspective that things have recovered from these previous drawdowns. This was the financial crisis. This was the tech bubble. January of 2022 to September of 2022. That was raising of interest rates. This is COVID. So I think that the more systemic the shock, the worse this can be. And so a tech bubble is sort of systemic. It's like, hey, when are these internet companies going to ever make money? The mortgage crisis, when are we going to lend money to people again to buy houses? There's a little bit of a lot of things in this particular pullback that we have now. So I would hate for this pullback to set the record of being the longest underwater period in recent memory. I would certainly hate for that to be the case. Let's go back again just to adjust this data for the longest period of time. 1972. What else gets in there? This is probably oil and interest rates in the 70s. I can't speak to that firsthand. I wasn't in practice, but 4 years to recover from that. This doesn't go back to the Great Depression, which I think was probably a 5-year or 6-year period. I just don't remember offhand. But I mean, these pullbacks can set you underwater for a long period of time. If you don't want to go along for the ride, for short-term results, with bonds here, will certainly have improved drawdown periods. So here's a bond market drawdown. We have here August of 20 to October of 22 was the drawdown, and this thing's indicating that bonds are not yet back to being above water. I'd have to fact check that quickly. March of 87, this is kind of around the time of Black Friday. It took 11 months for bonds to recover, a year, 2 months. So, well, I mean, if we're going to go from August of 2020 and it's March of 25, we're coming up on 5 years of bonds being underwater from a 17% drawdown. I mean, I certainly wasn't expecting to see that long of time underwater for bonds, but we've had such a sharp rise of interest rates. I mean, the way that happened Now I got to think about it, is we had very low interest rates, so very low interest rates to offset a decline in bonds. So when bonds went down by 10% and they were, because interest rates had risen, they were paying, a quarter of a percent to start. They rose up to 4%. So if you lose 10% and you earn 4%, it's at least a 2.5 year break even. And it could have been even a little bit worse for that. So that's why 2 years, 3 months, we're not quite to 2.5 years yet. It might take 3 years to get past that one. But I'm going on and on about this. I think what the point of this video is to say that for a diversified portfolio, these drawdowns can last for a handful of years. And they can be super unpleasant to go through. If you're withdrawing money or you don't want to go through such a downturn, bonds are going to be your safe haven. Bonds are not perfect, but they're certainly not as bad as the pullback in stocks. So I just sort of want to revisit this today, as it's really been quite an unpleasant month and just an uncomfortable year to date. And just know, as I record this, just know certainty. We need certainty. We need to know what the tariffs are going to be. We need to know what we're going to tariff them, what they're going to tariff us. And then we can start working our way out of this. But until that's known, we can't make forward progress until we've identified, until we know the rules of the game. You can't play the game until you know the rules. Let me reset this. So I don't think we'll make positive progress out of this while the uncertainty looms. But once we think we know the answer, or we do know the answer, that's when we'll start to make our way out of this. But at this point in time, there's just no visibility in the horizon for when this, how to sort of this tariff tug of war. There's just no uncertainty. There's no predictability for when this tariff tug of war is going to end. So there's been other things as precedents. Some of these things take a while to work through. There are solutions. There are solutions and steps you can take to protect yourself if you don't want to go through the downturn. Ultimately, time heals all wounds here, but it just may take more time than it has in the past. And you certainly hope that any significant structural changes are not so extreme that they prevent recoveries. So that's it from here. Just wanted to give you what was on my mind after such a day like today. See you back here soon. Thanks.